Hello, everybody. This is Guillaume Villon de Benveniste on the Innovation and Strategy blog. And today we are talking to Christian Fife that we spoke to recently, and I decided to invite him again to talk about the investor relationship more specifically. So Christian, let me set the stage. You earned multiple awards with the New York Stock Exchange investor surveys, ranking the investor relationship as a top 3 for 3 consecutive years. So just before we get into the details of what is investor relationship, could you tell us how the New York Stock Exchange is leading these investor surveys?
Sure, thank you. So the awards were given to the company I used to work with at the time, so WAPCO Holdings, in slightly different categories. But what is interesting, so they were a result of real teamwork with great number of leaders that were part of the company at the time before the company got taken over by ZF. As far as these surveys, this is a survey that is carried out by a magazine called Institutional Investor, that every year basically polls the key players in the investor community, be they sell-side analysts or buy-side analysts, and polls them to determine across various categories which are the ones that which are the companies that have done best in various aspects. And whether it was best investor day or capital markets day, where's the best investor relations officer, where's the best CFO, where's the best CEO, and so on and so forth. And to have a company such as ours at the time, capitalizing, with a market cap around about 8 to 9 billion, be considered in the same league as multi-billion companies such as the Ford Motor Company, just to name one, be in the same league as far as investor relations were concerned, is pretty humbling experience. So they do reach out and to these members of the investor community every year, and then they publish the results a few months later. So that was quite an interesting time we had back then.
Okay, so just to get a sense of, so what is the Ford capitalization? What's its cap market? Is it
well, it changes it changes every day, obviously, depending on a small change in share price. But yeah, it's in the several probably hundreds. Somewhere around that. Yeah.
Right. Yeah. So yeah, you're comparing 9 billion with 150 billion. Not exactly the same.
No, not the same size.
Not the same market cap.
But we're talking but we're talking probably around 300 to 400 other companies in that specific sector.
Right. Okay, I understand. Yeah, perfect. So now there are a lot of different questions to ask. Okay, so maybe very briefly, although you've already mentioned many things in your first answer, could you tell us why it's so important for any CEO to have a positive investor relationships?
So there are several reasons to this. Okay, first and foremost, let's not forget. Let's go back to some of the basics. Okay, so when a company is brand new, and we know that very often people say, the most important stakeholder in a company is going to be the customers, right? I don't debate that. It's actually very true. But go one step earlier, which is the company doesn't exist. Okay. So if the company doesn't exist, you have an idea, you're going to have to get some funding from somebody to start your operations before you can actually produce and sell your products to the customers. That money usually comes from investors. So investors provide money for which they will expect a return, obviously, because unless it's pro bono, but they will expect a return from the products that you will manufacture and sell to your customers.
Right.
So once the story starts flowing, then obviously you will want to continue ensuring that your success comes from selling to customers, but you still want to have the possibility to reward the investors who gave you the money in the first place. Now,
Right.
the investors that gave you money in the first place at some point might decide to leave the story and make room for new investors. So there
Right.
is a place where you can have this, sell and purchase of
Right.
shares of the company. That's the stock market.
Right.
So for a CEO, all right, for a publicly traded company in a stock market, be it New York Stock Exchange, be it Paris Stock Exchange, be it Singapore, be it Hong Kong, whatever. What you really want to do in there is ensure that your share price is a fair reflection of the valuation of the company. So how do you do that? You have to disclose information. You can't keep everything, in a small box, right? So if you do not disclose enough, that's one of the issues. Then you risk seeing a share price drop significantly because the investor community just won't have enough data to pull together
Right.
a solid investment thesis and will then stay away from that stock, right?
Right.
So that's problem number one. Okay. Now,
so sharing can mean multiple things. It can mean, if I'm in reference to what you just said, it can mean sharing financial information. But
yep.
I like a lot of other people, I read Investor Day notes, and it could also mean sharing strategic decisions and how the CEO, the leaders in a company are seeing their market change and what they're willing to change in their own operations to adapt and perhaps take advantage of any developing opportunity. Would you agree to that it's both financial information and strategic direction?
I would say the way you could think about it is any news that is material. Now, the concept of materiality is subjective in some cases because something might be material for one company and not be material for another. But what is material is definitely sharing information such as the one that you were talking about in terms of where do we plan to go. But in order for that to happen, you usually have specific events throughout the year, which are likely either going to be the earnings calls that you have to hold, where you systematically report on your results, and then you give a forward-looking view with a guidance on what's going to happen over the next period, or you use Capital Markets Day or Investor Days to provide a much longer range type of perspective. That's one. But what is also important is going to be whether there are significant changes in the management team. If a CFO of a listed company is going to leave, whether it's on his own, whether it's his own decision, or whether there's a different assessment that has been made, it is a relevant item because investors are going to want to know: is the person leaving because there are management differences within the leadership team? That's one way. Or is the person leaving because there are financial improprieties happening, from an accounting standpoint? Or is there, a personal matter, which in this case is not going to be relevant for an investor assessment, and things like that. So that is important information to disclose. Other important information to disclose, and all this is regulated for traded companies, right? Another information is going to be whether or not management is selling more shares than usual.
Right, exactly.
Does that mean that they see something adverse coming through and they just want to be able to cash out?
Right.
Or is it because it's just a tax planning matter and they need to sell because they need to pay taxes in different jurisdictions, personal income taxes in other jurisdiction, not
Right.
corporate taxes.
Right.
So those are all items that, you know, are regulated, so that, you know, all investors get equal access to that information.
Right. I know also that the financial and investment ecosystem is very diverse. So I understand that there are people that are called value investors, other people that are called index investors. There's another group that's called growth investors, and then they're activists, and also hedge funds. And I'm guessing that a lot of these people pursue different agendas. Is that the case? And if it is, could you tell us for each of these categories what agenda they're pursuing?
Sure. Look,
So
let me
maybe we
take
can start with the first one. What's a value investor, and what agenda is this person pursuing?
Yeah, okay. But before I will do that, before I do that though, I just wanted to give you a couple of fun facts, Guillaume, because maybe, you know, this can be relevant in terms of understanding the ecosystem, right, that you mentioned earlier. Did you know that there are around about 2,600 companies listed on your stock exchange, just from a US market? This is market from, you know, just as a data point. All right, and there's 3,800 on NASDAQ. And at the closing auction at the end of each day on New York Stock Exchange, there's approximately $19 billion worth of transaction. And this is being handled through approximately 17,000 institutional investors in the US. So just to give you a bit of a sense, so for any investor relation officers, you are in direct competition with approximately 3,000 other companies, all vying for the funds that are available at 17,000 customers who are eager to invest. Okay, that's just to give you a bit of a sense of the dynamics that we're talking about. Now, your question on the styles, the investment style, is interesting too, because, you know, to the initiated, uninitiated, this breakdown is going to give a sense of what is the stock perception. And it is going to be reflective of whether or not, you know, how much risk appetite these investors have. So let's go through the various styles. So growth. Again, these are broad categories suggested to give a bit of a sense. Sometimes, you know, the boundaries are not that crystal clear between them, but by and large, growth style focuses on stocks that have a potential to outperform the overall market. And these investors tend to do better when there are overall favorable economic conditions. So they tend to favor, in this case, smaller and younger companies in rapidly expanding markets. And they look for profits mostly in capital appreciation, so share price increase. That's growth.
Okay.
Trying to keep things simple. Another end of the spectrum is value investors. So value style then is focused on stocks that are trading below what they're really worth. Okay.
Yep.
So I don't know, at some point, you know, Apple was trading in the $1,000.
Right.
Now, if I'm not mistaken, it's probably, you know, it's gone down. But so I want to say maybe somewhere around the 600 or 700 or something like that.
Some people think, for example, that Facebook is undervalued.
Right. Yes. Okay. So let's take that. So
that's just an example. You know, that's very clear. As the time of our conversation, late February 2023, some people think that Facebook and also Google are currently undervalued. So I get the value investor, and then they're also. Go ahead.
Yeah. So they really usually come out on top when the economy is down. Now, and these investors tend not to follow the herd. And are more longer term invested. Okay? That's the value style.
Yeah, that makes sense.
Then what you also have is what there's an acronym called GARP, which means growth at reasonable price. And this is a bit of a mixture of the two that we just talked about, with usually, however, a stronger bias in favor of the moderate growth rates. Okay. Then, as another completely different style, you're going to have hedge funds. Now, hedge funds are typically aggressive investors and tend to invest for short periods, seeking to outperform market benchmarks. So usually, in my experience, I've seen hedge funds come in and out within the same quarter.
Right.
Multiple
So,
times.
okay, so we talked about several of the different kinds of investors, and there are still a few more to cover, plus a number of other questions. So maybe we can stop right here and go on to and maybe I can invite you again to another interview soon, and we can continue the conversation. Would that be okay?
I would love that. So thank you so
Well,
much for the opportunity.
thank you very much, Christian, and let's reconnect soon.
Thanks for having me, and have a great rest of the day.
Yep, you too.